Right, good evening everybody. Welcome to the RBS building here at Bishopsgate. Thank you very much for coming along. My name's David Gill. I'm Head of Product Development at Self-Trade. It's my job to introduce our speakers tonight and to welcome you here. I'd just say a thank you to RBS for making these excellent facilities available to us, or perhaps I should be saying thank you to you, as obviously you're key shareholders in RBS as well. So thank you very much for that. It does feel coming back here a bit like taking up one's timeshare allowance. We were here last year. This is our slot for this year, and hopefully we'll be back again next year, Josh. Couple of housekeeping things. Mobile phones, if you would please, at least make sure they're turned on to silent, if not off altogether. We may well have a ringtone competition otherwise a bit later, which could be embarrassing for some people. Fire, there is no fire test due to be conducted tonight, so if there were one, follow us quickly out the side doors and we'll be leading the way. Toilets, for those who may need them, if you'd like to go out through the back doors, follow around past the lifts down on the right, and by all means do avail yourself of those. It is very timely that we should be having this event tonight. You'll have seen the unrest in the press in France with people protesting about the retirement age going up. You'll have seen the process in Greece over government finances and the trials and tribulations it's causing there. And those of you who have been keeping up with the news today will have seen that there have been announcements, as expected, about the new arrangements for pensions. And Francis and Russ will be picking up on those a little bit later for us. So our timing is excellent. Perhaps, if anything, maybe a day or two early, because we won't have had time to digest all of the nitty-gritty. Francis, I think you said about a 30-page document issued today. And, of course, that's in the usual small print. So I'm sure that'll be digested in the press over the next few days. So let's get underway. I thought I'd just share with you a couple of anecdotes that show just how much pensions are in the limelight at the moment. Self-Trade is celebrating its 10th anniversary, and we ran a competition for people visiting our website and asked them to suggest a couple of new phrases that might epitomise the environment today. And we've had a couple of interesting suggestions, many of which actually focused around the retirement issue. So you could become a WOPE in future years, which is a person still working after pension age, given that things have been moved up fairly rapidly. And instead of having retirement, you're just going to have tirement, because that's someone who will... the average man must now have lived a tired life to the end of his day, because he's not going to get much time in retirement. And then there's also reta job as opposed to retirement, which is employment past retirement age for those people who haven't made provision for their pensions to a sufficient degree. I'm sure that the very fact you're all here tonight means that you're not going to fall into that boat. And I hope some of the ideas and some of the suggestions and comments that our speakers are going to share with you tonight will give you the confidence to go on and make the right sort of pension provision for you, whatever that may be. So, without further ado, let me just briefly run through tonight's agenda. So we've done the housekeeping bit. Russ Mould from Shares Magazine is going to be talking us through the pensions landscape, where within the whole plethora of pension arrangements, and indeed arrangements to come, does a SIPP sit, and what sort of things does it do, and how does it complement what's already available. We'll then be looking in more detail about the role of the SIPP trustee and administrator. Often people wonder why they might need to have one, how they go about choosing one. So Francis is going to cover that for us. We're then going to look at probably one of the key things about, okay, once you've got this thing called a SIPP, what do you do with it? And what can you invest in? How should you change your strategy, if at all, from investing, and might that need to look differently? And then Josh from RBS is going to talk us through some of the structured products that are available these days, and listed products, that can act as anchors and roles within a pension as well. If I could ask you, please, if you've got questions, could you jot them down as we go? We have got a Q&A session at the end. It will enable people who have got similar questions to share those at the same time, and it will keep things moving along a bit. So if you have a burning question, jot it down. You really won't forget it by the time we get to the end. I see most of you have grabbed goodie bags, so that's something for you to take away and enjoy later, and we'll cover what's in those in a little while. So Russ is editor of Shares Magazine. Quick show of hands, Shares readers, anybody? Loads over this side, you'll be pleased to know, Russ. And of course, we're also pleased to have Investors Chronicle with us. So Investors Chronicle readers, there's a few of those as well. Just to give our speakers an idea of the sort of feeling in the room, how many people already invest in for their own account? So they're self-directed investors, make their own investment choices. Good, excellent. So good. So you'll understand some of the terminology, you'll understand some of the risk that's involved, and we will be talking about the pros and cons of SIPPs and some of the decisions you might need to be making. In terms of that, ISAs, okay, these shares, ISAs or cash? So cash, yeah, good strength of shares, ISAs. That's what we find too at self-trade. People who've got ISAs tend to move on and also become confident in managing their own pensions. So we've got a good knowledge of understanding in the room here tonight, gentlemen. So without further ado, let me introduce you to Russ, who's going to take us through the pensions landscape. Thank you, Russ.
Right, thank you very much, Dave, and thank you very much, everybody, for your time this evening. I'm going to be here, as David said, just very quickly setting the pensions landscape as it stands today, explaining how a SIPP fits within that. I will keep this very short and sweet. One, because so many of you are clearly very confident about running your own money anyway, so I'm largely singing to the choir. And two, that 30-page announcement today, I haven't had time to read it, and it's rendered some of my presentation out of date. So I will be glossing over some of the finer details and hoping that Francis can bail me out in about 45 minutes' time. I've actually been sat editing a piece on nuclear power for most of the day, so don't go nicking that one for next week, will you, John, if you wouldn't mind. So off we go. So that's what we're going to be looking at, the future, then the various different flavours of pensions that we can go through, finishing off with a self-invested personal pension. So it obviously can seem an awfully confusing world, pensions. I think, Francis, you've coined the phrase, is it recomplification, I believe? And although the government pretends it wants this to be simple, everything it does seem to make things actually an awful lot more difficult. The one conclusion that's clear, and it's clearly one a lot of you have already come to, is that doing nothing is definitely the one option you must avoid at all costs. And the reason for that, well, this is some of the rather alarming data that was published in a survey last summer. 24% of the over 55s have, well, effectively no pension provision whatsoever. Nearly half of 25 to 34-year-olds haven't given it any thought at all, and 13 million Britons in total, no pension arrangement for themselves and are relying on the state. Now, that may have seemed like a very good idea one time, but obviously what we're reading about now is the government has got no money and is therefore doing its absolute best to find money, income from any possible source that it can. So yes, there is a state pension provision, but unfortunately a third of the population are planning on living on £97.65 a week for a single person, or just over £156 for a married couple. Now, it all helps. I'm sure none of us are necessarily demanding a Krug and caviar lifestyle once we've retired, but on balance that probably isn't going to go desperately far. The debate over what the retirement age should be, well, obviously, again, David's touched on that. That 65 limit for both genders by 2020 is going to be scrapped. And in the end, the state pension can be taxed and is not available to you if you're self-employed. So there are a fair number of caveats even to that. So a rather facetious picture of baked beans on toast. As a good Yorkshire lad, I'm quite partial to them myself. But nevertheless, it isn't necessarily how we all want to spend the final 20, 30 or more years of our life. There are obviously other schemes which the government various governments and administrations have tried to foster. The state earnings related pension scheme is obviously one, but it is going to be replaced. It's ultimately funded by higher national insurance contributions, is in the process of being wound down anyway, and is linked to past earnings and has a fairly restrictive cap. And again, the poor old self-employed are not entitled to it. So it all helps, but again, we're not, unfortunately, talking about life-changing sums of money. Occupational pensions. These can vary enormously in degree of the lavish arrangements they offer. Contributions, they can involve contributions from you, the employee, contributions from your employer, additional contributions from you, and a mixture thereof, with two ultimate goals. One, buying a defined contribution scheme, buying an annuity, a pot from which you can then draw income, or a final salary scheme, perhaps the holy of holies in many ways, but they're awfully expensive for employers, and they're based upon how many years you've worked at your firm, the accrual rate, the salary that you finished your career with that particular company at. It's awfully complicated, it's awfully expensive. There are just 3 FTSE 100 companies now offering them. Rather more topically, Sir Philip Green, anybody heard of him? Bit busy at the moment in the newspapers. He's just in the process of closing down the final salary scheme for Arcadia Group executives because it's, again, costing him rather a lot of money. And I believe there was an announcement today about final salary schemes, Francis, in that 30-page document, which Francis will be dealing with later on. But effectively, they're going to be taxed in a fairly punitive manner. So the final salary scheme, if you've got one, fantastic. There is a danger that it'll either be abolished, watered down, heavily taxed, or whatever by the time you actually get to get your claws on it. Occupational pension. So, again, what have we got here? The Great White Hope, the occupational pension. All employees, well, really by next year, or 2 years' time, all employees will be automatically enrolled. This was a Labour idea, so again, this is open to debate. There'll be an employee contribution matched by your employer. You can opt out if you wish. There'll be a movement clause if you change your job. At least it won't be very expensive to enlist at around 0.3%. But again, this is not set in stone. The next option, stakeholder pensions. So we've been through the state pension, the SIPP scheme. Now we're on to stakeholder pensions. This really is the sort of thing that my firm shares, not MSM Media, not very big, 30-odd employees at the most. Any firm over 5 people must offer a stakeholder pension. At the moment, my firm is not obliged to offer me one and therefore exercises that option quite happily. These are going to be low cost, flexible, no upfront charges, some nice tax breaks for marginal rate payers particularly, and again, can be used parallel with existing schemes. So these will be coming in, these were introduced a while ago, and frankly, again, have their advantages, but again, we're not talking about life-changing sums of cash. Now, we're moving on to where things get really interesting. Again, all those hands that went up earlier on, personal pensions. Money is given to a pension provider who invests the pot, in theory, extremely effectively, and in theory, it goes up in value in time, either due to the abilities of the fund manager or, more likely, all boats rising with the tide as markets go up. Touch wood. On retirement, that pot is then used to buy an annuity. You can cash in tax-free on retirement, a certain percentage of it, a quarter, and you can have more than one. There's no capital gains tax on any gains that you accrue, but there are ultimately limits to the breaks. So this is looking a little bit more like it in that there is potential here for substantial upside. There are, again, with all the other options that we've talked about, whether it's size, tax, flexibility, costs, there are drawbacks. The money is invested by professional fund managers. Now, I've got to come clean now, I used to be what was known as an investment banker, which, when I worked for UBS Investment Bank, though I actually joined SG Warburg in 1993. And all of you who haven't read Niall Ferguson's book on the great man, Sigmund Warburg, I can thoroughly recommend it. But in my 12-year career at SG Warburg through to UBS, I think I had to talk to about 160 professional fund managers 2 or 3 times a week. Nice people, most of them bloody useless. Bright, smart, understood the market, couldn't outperform. It's just the way it is. Market's very, very, very sharp, and to outperform, you've got to be very, very, very good. And okay, names like Crispin Odey stand out, Neil Woodford stand out, George Noble, but they're very, very, very few. Of that list of 160, I would have probably entrusted about 10 of them with my own money. So it's a big industry. The fees can vary enormously and can be very opaque. I'm not saying it's not run by nice people or well-intentioned people, but they are taking some big fees and they're not always outperforming the index, providing you with the performance that you deserve and indeed need. So fees vary, and by gum, so can performance. So this is ultimately the rationale for why a lot of you already have taken the plunge and actually felt that you feel confident enough and market savvy enough and aware enough to manage your own money, because you know the government isn't going to look after you, You know that fund managers will try with all the best intentions in the world, but they might not do a very good job of it, and they might charge you a lot for it. And yes, you may be in the lucky position of having a final salary pension scheme, but the way things are going, the odds are that cup may be dashed from your lips before you get there. So there's every reason for you to certainly consider a self-invested personal pension. Again, they're not perfect. Francis will take you through a lot of the complications involved, but they are certainly an option that is well worth considering. Again, this comes back to just how many people don't take an active interest in looking after their cash. Nearly 17 million Britons, again, the same survey from last summer, nearly 17 million Britons don't know what's in their pension plan, even if they've got one. Of those who did check, 7 million still didn't really understand where on earth the money had gone or where it was, and about another 7 million had done the easy thing of, oh, I can't really want to worry about this. Default, click, I'll just let the pension fund manager get on with it. I don't know where on earth the money is. It could be in Mongolian mining stocks for all they know, which actually this year, not a bad thing, by the way, just about the world's best individual performing stock market, up 120%. But on balance, not always a good thing. And obviously, every individual here, different stage of their career, different stage of their life, there will be certain shapes of portfolio better suited to your investment needs depending on where you are in that, in the great journey. And I think Jonathan will be talking more about that later. Earlier in life, you may feel more willing to take more risk. Later in life, you may be opting for capital preservation, depending on what your cash requirements are. So just pressing default, you may end up with something totally unsuited for what you need now, today, or what you will need in the future. So these are the rules that I think have changed today, which is now where I've got to move extremely quickly. So for this year, I believe the maximum investment is still £255,000. That will go down to a limit of £50,000 after the white paper that's come out today. The lifetime allowance of £1.8 million will come down to £1.5 million. That was a lucky guess, but I'll take it. Thank you very much. There are income tax, capital gains tax, and inheritance tax benefits, and generally, and Francis is your expert here, low administration costs. Funds can be drawn down between 55 and 75, depending on when you wish or feel able to stop working, although the government is looking at various options here, and there may be details in that paper today. And your existing pensions, if you wish, can be transferred into a SIPP, and this is where it does get interesting. Multiple forms of asset class are permitted within the self-invested personal pension. And this is why I've really called this presentation about, power is nothing without control, that old Pirelli advert featuring Cal Lewis and then Florence Griffith Joyner. Because you can take control of where your money is invested, because you're making the decisions yourself. So you're not paying a fund manager who's skimming 2 or 3% off the top to put your money into, Vietnamese agricultural companies or pharmaceutical companies or bonds or whatever it happens to be, things that you don't necessarily feel comfortable with. It gives you the option to invest in what you do feel comfortable with, which will inevitably, or should be, things that you understand or have taken the time to research and understand. Now, all of these asset classes here are suitable, in theory at least, for a SIPP. Again, Francis will take you through some of the finer points because it's not entirely straightforward, but stocks and shares, equities, collective investment funds, hedge funds, structured products, on which there's a presentation later, good old-fashioned cash if you think that there isn't an inflation bubble coming, gilts and bonds, ditto if you think there isn't an inflation problem coming, property, it's where it starts to get complicated and I'll back off, exchange-traded funds, contracts for difference, the ability to go short if you think something's about to go terribly wrong. All of those are available to you. Art, wine, racehorses, technically, yes. Francis will probably do his best to put you off looking at those alternative asset classes, at least within this wrapper and within this context. Not because per se they're necessarily bad investments. But all of these options are available to you, so long as obviously you feel comfortable with them, sufficiently knowledgeable enough about them to make sure that you're happy to leave your money in them to provide you with that welcome income stream once you retire. So in addition to the flexibility, the ability to take control of your own money, to put it where you feel happiest, you do get a bit of an edge on the tax man here, which is in the end the best news of all. Nothing to pay up front, Good news there. And for a 20% payer, you get, for every £800 you put in, the government gives you an extra £200, so you effectively get 20% knocked off your income tax bill. That is powerful mathematics. For the higher rate payers, and I've just done this for the 40% rate, not for the 50% one that was introduced recently, the mathematics is every bit, indeed if not more compelling, because you get, again, that marginal rate knocked off the income tax bill, 40%. So you put £800 in, another £200 appears via the self-assessment return, and then your administrator will claw back the extra £200 again, giving you a whacking great return, tax-free. Thank you very much. Capital gains tax, hooray! And I actually did get these numbers right. I panicked that I'd got them wrong. 100% tax relief. Now, I knew I wouldn't get that wrong. Everybody's subject to 18% tax on gains above the limit of 10,100, and higher rate, 28%. In a SIPP, that does not apply. So again, you get the big upfront kicker, and then anything that you can do positively with your money thereafter, again, that's not taken away from you. Dividends, there's nothing we can do here. Everybody ends up having to pay 10% withholding tax at source. There's just nothing that can be done about it. So if you're an income investor looking to get returns trickling into that pension pot from high-yielding UK stocks, say, like Royal Dutch Shell, National Grid, AstraZeneca, British American Tobacco, all yielding, or the utility stocks, all yielding 4, 5, 6 or 7%, you're still going to have 10% of that taken away from you, no matter what we do, because that's just the way it works. If you're a higher rate payer, you then, if it's not, the stock is then not held within a tax-efficient wrapper, you get clobbered for an extra 25% deduction, making for a net rate of a 32.5% tariff. Within a SIPP, you don't get that second bill, that second 25%. So you effectively get 69% tax relief. If you were due £100 in dividend income from your 7 Trent shareholding, you'd get 90 quid if you were a lower rate taxpayer. If you were a higher rate taxpayer, once you pay the second tariff, you normally get £67.50. Within the SIPP, you get the same 90 quid that the lower rate payer would get. Now that's really got to be worth considering. Again, particularly when I know they're open to debate, in theory at least, stocks provide you with a long-term income stream. The average yield on a FTSE All-Share since 1962 has been 3.8%. The compound capital growth in the All-Share since 1962 has been 7.1% against long-run UK inflation of about 6%. Now that's over a 48-year time period. In the end, you get the income, you get the capital gain equities, over that time period have outperformed inflation very nicely. I've got to accept over the last 10 years, they've actually not done a fat lot at all. So it depends on where your starting point is. But in principle, at least, income, it will be a big potential option for any SIPP user, SIPP buy, and I'm sure Jonathan will take you through those numbers, probably dismiss them as casuistry, but nevertheless, it is worth bearing in mind that income is a big potential option, again, because the tax options here do work in your favour. Then, obviously, once you get to the age at which you wish to retire, or which you wish to say to your boss, thank you, but no thank you, I've had enough, you can draw down this nice big tax lump sum. You do then, unfortunately, cop a little bit of tax, but Francis will take you through this particular minefield. The trustee will then ensure that all of your credits come through appropriately. So, started off with a very facetious picture of baked beans, finish off with an equally facetious picture showing you that perhaps with a little bit of careful research, careful asset selection, careful stock selection, good advice from your broker, careful choice of fund manager, you may well indeed come up with a pension pot that will enable you to live in the lifestyle to which you're becoming accustomed or to which you aspire once you stop work. And certainly at least, you're not left relying upon government largesse, if that's the right word, because frankly there won't be an awful lot of that to go around, or indeed corporate largesse, because again the chances are those final salary schemes will be potentially taken away from you, as they're very, very good for you, which means they're unfortunately very, very expensive for your employer, and ne'er the twain shall meet. So in conclusion, despite today's white paper, in theory the government still does want you to save, even though it's now contemplating increasing the taxes and lowering the contributions you can make, because they really do not have the money or the wherewithal with which to look after you. A self-invested personal pension will offer very healthy tax breaks, income tax, capital gains tax, and inheritance tax. It gives you the option to manage your portfolio in an active fashion, or even if you don't feel entirely comfortable with that, in a passive one, by choosing a fund manager whose the brand of whose firm you trust, whose long-term performance record stands up to scrutiny on a 3, 5 or 10-year view. Or you can just think, actually it's all going to hell in a handbasket, I'll stick the money in cash, there's a big deflationary problem coming, and in real terms the value of your cash will grow tax-free. So again, even if you're very, very bearish on life, there are still potential gains if you feel brave enough to back the courage of your own well-researched convictions. So a self-invested personal pension will offer the savvy investor a chance to take control of your money, get the portfolio to reflect your own views of the world, and just as importantly, your own risk appetite and your own return aims. Now, risk appetite, there are, obviously, with investments, things do go down as well as up, and there can be accidents, crashes, and goodness knows what else. All I would suggest there is any good investment is targeting a return that compensates you for the risk that you're taking. And if you feel comfortable with that equation, then you can set up the portfolio you want quite easily. And just very systematically, if you think about it, that UK 10-year gilts are currently yielding 3.3%, thereabouts. Okay, in theory, risk-free. Okay, the UK government is not going to default. So you'll get 3.3% per annum from owning a UK 10-year gilt, basically on the grounds that that is definitely going to come in. So if you therefore invest in a corporate bond, company could go bust, do something stupid, CEO could abscond with his mistress and take all the money, there is going to be a little bit more risk involved. So relative to 3.3%, let's say you should actually get 5. If you're investing in a stock, when if the company goes bust, you're going to get nothing and you're way behind the creditors, you're investing in a utility where we know what the income stream is going to be, we know what its capex requirements are because they're regulated, maybe you should be demanding 6% return per annum. Tesco, 8%. British Aerospace, maybe 10. Moving up the risk levels, your return should be a commensurate multiple of that ultimate risk-free rate. So once you get to Rockhopper Petroleum, Rockhopper Exploration, or another hole-in-the-ground enterprise which could make it big but equally could turn out to be empty, you really should be demanding 20 to 25% per annum returns at a minimum to compensate yourself for the risk that you're taking with your money. Those guys are drilling a hole to find out what's there, and if they don't know, you've no chance. Now, that doesn't mean that these companies are frauds or not properly run, but they're in the risk business. So risk appetite, incredibly important. Know exactly how much once you set out how much you want to earn, then you can judge how much risk you have to take to get it using that very simple pyramid calculation. And that's really a big secret to any investment. It will help you avoid putting money in things that you think, if it went wrong, you think, what on earth have I done that for? So that, I think, is very, very important. These wrappers are very, very powerful, but again, you need to set your own limits for yourselves. How much do I want when I'm 75? I'm here, I need to get to here, X% per annum, and then use that very, very simple calculation. And it will give you an initial guide to how you need to get there and then how much risk you need to take. But this is the sort of tool, at least, that can help you get there without having to put as much money in because the taxman's not taking quite as much out. So thank you very much for your time, everybody. There is a copy of the magazine in your bag. Hope you enjoy it, those of you who aren't regular readers. And I do look forward to taking your questions at the end of this session. Thank you ever so much. I appreciate your time.